Hi, everyone. Just before we get going, I want to remind you that everything we talk about and discuss should not be considered as investment advice. The purpose of what we talk about on Catherine Murray Media and Markets on YouTube, as well as Catherine Murray in Conversation With on my podcast, should be viewed as informational and entertainment purposes only. Please definitely do your own research, your own homework, and definitely consult an investment professional before making any investment decisions. And also to note, some of us might hold positions in some of the stocks that we discuss. Jason, great to be able to catch up with you. I think that for viewers, listeners to understand, you guys have, a different background and a different approach, which I think is really important. It's an area that not everybody knows of. Proprietary trading is your background, and it's, I think, one of the most interesting areas of the market that, through new regulations, or now they're not even new, the investment banks aren't really allowed to have anymore. But it's incredible background to really understand the markets and to make decisions based on exactly what you see. So why don't you kind of just give a quick background in terms of what prop trading was and how you're using it for investment purposes today for your clients?
Sure. So our background is prop trading, as you mentioned. That's just another word for running money for a bank. In our case, it was Scotiabank. And really, trading the bank's money teaches you, you've got one client. If you lose that money, you're going to get fired. So it teaches you first and foremost risk control and risk management. And that is very much what we see ourselves as when we run our liquid alternative mutual funds today. We use a lot of the same strategies and understanding of risk in our funds that we used while we were at Scotiabank. But really, now we're applying a quantitative or a systematic process to stock picking, both long and short. So one of the things that is very similar about prop desk is you have to be focused on the risk. One of the things that is different is that now we distribute our funds to a much broader base of clients. We're typically in the advisor channel. So advisors at the major banks and independents would use our funds typically as a replacement for bonds or a replacement for traditional stocks where they want something that isn't perfectly correlated with traditional markets.
Okay. And, it's important as well, perhaps, to, make it understood that, a lot of investors, a lot of retail clients, unaccredited investors really didn't have access to hedge funds. And then you saw a lot of the big banks, advisors really wanting that type of investment for their clients. And so we've got these kind of liquid alternatives is how I see the evolution. Correct me if I'm wrong. And so that's really, for anybody listening, when they hear their advisor say, well, let me give you a liquid alternative, that's what you're doing. Maybe just describe exactly kind of what that is. It's kind of the next iteration, I believe, of a hedge fund, but for, a broader audience.
That's exactly right. I mean, the term hedge fund is often used as a dirty word. I think that a properly run hedge fund actually is built to reduce risk, not increase it. And that ultimately is what the regulators saw as well. So in 2019, they made a shift that allowed a traditional mutual fund to be enhanced with two things: the use of moderate leverage and the use of shorting. So you could actually make money if a stock or a market went down, not just up. And those are actually, if used properly, risk reduction tools. So we have been doing that already in, as you stated, the private market. But the challenge with that is it really was only available to accredited investors or high net worth. This really democratized this change. And so now you'll see liquid alternative mutual funds available from a number of managers, not just us. There's a dozen managers, some of them very well known, like a CI or a McKinsey or Dynamic, that would have liquid alternative mutual fund products, and we fit right into that bucket. So the big difference is they're daily liquidity, they're regulated by the regulator, all the same reporting, actually enhanced reporting versus what you would get from a traditional mutual fund or ETF.
Got it. Okay. It's important to kind of lay the land, because I think so many people hear, what's a mutual fund versus this versus whatever, and they are different, and there is an evolution that takes place in terms of financial products.
That's right.
So with that said, and with your background of prop trading, actually, I actually did equity research at William Blair back in the day, and then went into institutional sales. But my specialty was specialty retail, and so I kind of had the opportunity to get on the specialized retail desk at Goldman, but I didn't do it. So that would have led to a prop position, I hope, because that was the best. I think that was one of the most interesting positions to have, period. I mean, you're trading and investing the bank's money. I mean, that's one of the top positions when people put you in that position. Pretty exciting.
No, it was a fantastic experience. The reality is, after 2008, the Lehman crisis, prop desks just disappeared. They were regulated away in the US, and in Canada, the risk appetite just wasn't there anymore. So we never had a down year, including 2008, because we always saw ourselves as being risk managers first. And frankly, we weren't geniuses. We just didn't understand the longer term impacts of what we were seeing, and just moved to the sidelines, just cut risk during Lehman. The prop desk structure disappeared in Canada and really hasn't come back. But what it led to is a lot of former prop desk managers moving over to start their own hedge fund firms, us being one of them. But I can think of 3 or 4 other successful managers in Canada that came from that exact same background.
Interesting. So talk to us then about what you're seeing in the world today. I mean, I know prior to this interview, we were going to, talk about SPACs and some of the meme stocks and the NFTs. Why is that of interest to you, or how are you playing it?
Yeah. So if we look at, let's say, this calendar year as a starting point, there's been a couple of major cycles, if you will. The first being in that first quarter of this year, the mania in SPACs, the mania in technology stocks, particularly things like electric vehicle and battery companies and any kind of emerging growth company. And many of these were actually taken public via a SPAC. So, for the viewers who aren't familiar, a SPAC is just a pool of money with a sponsor or promoter. You give them money at $10 a share, and they've got a timeline to go find something to buy. So it's almost like, if you could buy the next IPO, not yet knowing what it is, the next hot IPO, with a guarantee of getting your money back if you don't like the target company. That's what a SPAC is. So from our perspective as a hedge fund, what we want to do is buy SPACs below the $10 that you're guaranteed to get back. So right now, there's about 600 SPACs trading in the market. Almost all of them trade below the cash value in trust. So we can't lose money on that as long as we hold it to the point where they consummate a deal, because we always have the option to get our money back with interest. And if we can buy it cheaply, we're buying, dollars at 97 cents. That's a good strategy. The strategy got really unhinged though sorry, go ahead.
Well, I just want to ask you, because, I've heard of some of the hedge funds that are kind of playing, I don't know if that's how they're doing it, the risk arb aspect of the SPAC.
Yes, that's exactly. So that's risk. That's the risk. That's a pure risk arb. Let's call it a rate of return. So we're just looking and saying, all right, if we buy this SPAC today and hold it for 6 months, we're going to get a 4% annualized return. We can add a little bit of leverage. There's no credit risk. There's no, sort of downside risk like a traditional merger arb deal. And there's no credit risk like a high yield bond. But it compares very favorably with both those other asset classes, right? If you could buy a bond that has no credit risk for 4% annualized today, that's a pretty good rate of return. And that's what's happened in the SPAC market.
So just walk me through this, because I know you're going to go down a different path in terms of, what's gone on in the SPAC market. But this is also an investment strategy that people are employing. So how does it work? So if someone's going to be issuing a SPAC, you're getting in on the issue?
Generally not. We actually tend not to participate at the issue at the $10 price. We wait until it's trading in the market, because more often than not, they trade below $10. Okay. What happens is when you buy it on issue, it comes with a stock and a warrant, and then it splits into 2 pieces. We can buy that stock once it's trading separately from the warrant, and we can typically buy it, reasonably well below the $10 price. So 9, 9.70, 9.75, and get that guaranteed 25 cents between now and when they find a deal. If they can't find a deal, they're forced to unwind it, we get our money back. If they find a deal and it's a lousy one, we get our money back. If they find a deal and it's a great one, maybe it trades to $12, $13, $20, like we saw in Q1, and we can sell it in the market at a better price than that. So the normal trade is just, all you really want is that little rate of return. Q1, it went ballistic to the upside, where you were seeing every deal announcement, no matter how bad the company, trading at a massive premium, right? We saw some SPACs trade at $30, $40, $50 with only $10 in cash, right? So the buyer, who's buying it at $50 a share? Unfortunately, the retail bag holder, right? It is someone who is looking at this new company and saying, I love that this is the next Tesla, right? Or I love this is the next Virgin Galactic or DraftKings. And there have been some really good businesses come out of SPACs and a lot of very bad businesses that have come out of SPACs. So, from a pure art perspective, the arbitrageurs were sellers of all those pops. But the unfortunate part is the average retail investor paid up for these, and most of those are well below those prices now.
And so when a SPAC though would come to market, when a SPAC comes to market, you're going to wait to buy it at less than the issue price of $10.
Correct.
But I guess it sounds like you don't always get that chance.
Not always.
People get excited about who the money manager might be, but they don't even announce. They obviously don't, like, for it to trade at $50. It's really just trading on the on the belief that the person who's issuing it is going to be buying some great company, because they don't even already announce the deals most of the time. Yeah,
so you're right. In Q4, Q1, you saw exactly, like, take Bill Ackman's SPAC for an example. Largest SPAC ever done in terms of cash raised. Obviously Bill Ackman has a reputation that supports that. That SPAC traded, I want to say 30% above its cash value before he had found anything, 30, 40%. Ultimately, as he didn't find anything, and then he had a failed deal, traded all the way back to cash value. And today you can buy it for slightly below cash value. So you're right, that traded purely on the prospect. That's not something we're interested in at all. The other thing that happened though is people were finding deals. I'm thinking of something like Lucid. So Lucid is the next Tesla, right? And people would find a real deal, and the stock would then trade up to $50 just on the prospect that Lucid was going to become the next Tesla. So there was a real mania in these growth type companies. And we saw that it coincided with the meme stocks taking off. It coincided with the Melvin Capital blowing up, being short these stocks. It coincided with Archegos, the family office that Bill Huang, blowing his fund up. So, there was a real mania in that kind of ended kind of late March, early April. And then the market has changed since then. It's gone on to more quality stocks. And the hedge funds who are long and short, like us, have had an easier time, if you will, managing the short side of our book, because it seems like that speculation has gone on to greener pastures.
Where's it gone?
My personal view is two things have happened. People have returned to work. So, CERB checks or unemployment benefits have run out. Sports betting has come back. If you think of the pandemic, a lot of people sitting at home, not necessarily going to jobs or working from home, and receiving stimulus checks. So there was a lot of excess speculative money, if you will, used for that had gone away from those two things. They're back. But the other thing that seems to be attracting this sort of retail spec flow is crypto again. Crypto and NFTs, non-fungible tokens. So, I describe it as a Ponzi scheme built on a Ponzi scheme, but, I'm 50 now, or I will be this year. So maybe I'm truly out of touch, but when a digital image of a rock is trading at $2 million, I'd say we've reached the boundaries of rampant speculation.
Yeah, well, and that's my view as well. But Jason, when you hear people talk about the NFTs, they seem to describe it And, I don't pay too much attention to it because it's something that just inherently doesn't make sense to me. I like, doing more hard equity research. But I guess their explanation is, well, if you're a famous person and they kind of want a piece of you or a slice of you in whatever that means, like, I don't know if it's your artwork or your trophy, you technically own part of that trophy. I mean, that it's a way to kind of divide assets that somebody might have.
Yeah,
Fair-ish?
that's fair. I mean, you could view it as digital art, right? I mean, look, a banana duct taped to a wall sold for $120,000 at the Miami Art Show a number of years ago. So we can say yes, we understand that the art market can have its own mania. NFTs, you could view them as a form of digital art, and the values in the whatever someone wants to pay for it.
Yeah.
I think the challenge I have with it is it actually isn't anything unique. Really, what you're getting is your name, effectively, a digital code on a ledger on someone's website that says you're the true owner of this. The value really is in the ability to turn around and sell these, to trade these. And that's why this market, you look at OpenSea and some of these NFT marketplaces, the volumes have exploded. It is the latest toy, if you will, for rampant speculation. I see now that NFTs are already starting to crash already in some cases. So, there's just been a massive supply of digital images. Who would have figured? Because they can be generated on the fly, and if you can sell it for more than a penny, you're doing pretty well. It's just, but to me, it's just another example of the unintended consequences of a lot of money in the system, and a lot of money being put into individual hands as a consequence of trying to get out of this pandemic.
Mm-hmm.
It's fueled speculation.
It's what?
It's fueled speculation in a lot of asset classes.
Yeah. And so, and we briefly mentioned the cryptocurrency world. Where do you stand on that right now?
We're nowhere. I'm like you. It is, we have huge issues with it structurally. When you start to dig under the hood, and not to say that digital versions of currency don't have some appeal. They really, to us, don't solve any problems that haven't already been solved. We can transfer money very easily today. Certainly, they might reduce friction costs, but they haven't yet. They're terrible for the environment. I don't care what anyone says. It's a ridiculous, particularly Bitcoin and these proof of work coins that actually require a huge amount of energy to produce. So conceptually, you can understand there can be benefits from it, but I yet to see a business plan in crypto that doesn't rely at its core on the asset class going up perpetually, right? And that to me is not a sound reason for it just, again, sounds like another way to say speculation. No one's shown me a business plan where Bitcoin can just be flat and there's an opportunity for people to make money. They all seem to rely on this perpetual motion machine that goes up.
Yeah. Well, and I actually am involved in crypto, not the NFTs. So, with all of that said, and you've got a long short book as well, where are you investing? What do you feel comfortable in today? Especially because, you've talked about the amount of liquidity out there that's increased asset prices across the board, it sounds, and that I would agree with. And then you've got people with Tina, there is no alternative. You've got people who are believing that because of COVID, the business cycle will be elongated even more. You've got people who believe that there's no way any central bank in the world can raise interest rates to such a degree because they won't be able to, afford the interest payments. So that kind of lends itself to, this continued lower for longer. What do you do in that? What do you guys do?
So the benefit of being long and short, and I fully agree, the market is in an absolute aggregate manner very overvalued, but there are absolute pockets of reasonable value and absolute pockets of excess. The benefit of being long and short is that we're not as concerned with the overall market valuation. We care about relative valuations. So if we can find a stock that's reasonably priced, like a slightly more cyclical financial, or a lumber stock, or a steel producer, or potentially an energy producer, those are the things that sort of float to the top of the pack today. And we can be short something that is overvalued or might be subject to a different risk, like a utility, where they're already expensive, or a consumer staple, they're already expensive. And if we do get into a period of inflation where rates do go up even marginally, those companies are going to be, have more risk of multiple contraction. So if we can balance a portfolio where we're long things that are cheap in an uptrend and relatively stable, short things that are expensive in a downtrend and relatively volatile, that's how we structure our book. And we come at it from a quantitative perspective. We're not stock pickers in the traditional sense. We want to own a basket of stocks that are cheap, rising, and stable, and we want to short a basket of stocks that are the opposite of that. And that changes over time. The cohort of what is in that basket changes over time as the cycle moves through the market.
So when you talk about cheap, rising, and momentum, or cheap, momentum, and rising, I think, those are the factors that you look at. How are you, I'm just curious, because back in the day when I did institutional equity sales, I did cover momentum money managers. It's almost kind of, you don't even hear about them really today, I don't think. But so what do you use to judge momentum, if I'm using it even in the right way?
Yep, you're using exactly correct. So we, and you're right, when I was at Scotia, we also covered clients, and there were a number of I would call them momentum shops. You knew that they were going to be buying when the price went higher, right? Not the opposite. And then you have value managers that were going to be buying as the price goes lower. And those are your two sort of big cohorts. So for us, we look at momentum in developed markets like the US. It's as simple as looking at the last 9 to 12 months of price performance. Stocks that have had the best return over that period have high momentum. Stocks with the lowest returns have low momentum. In more emerging markets, and I'll actually put Canada and Australia in that bucket because of our resource bias, we trade more like an emerging market. You have to shorten up that timeline. So we're looking more at 6-month momentum, because the cycles can move very quickly. And you've seen it, energy stocks bottom, and then they very quickly turn the corner and rally. If you're too slow to start to change positioning, you can get caught doing that, particularly if you're long and short. So that's momentum. And then we pair that with value. So and value for us is very similar to traditional. We look at things like price to free cash flow, return on equity, what's the balance sheet, what's its earnings, what's its dividend yield. So we're trying to find that blend of a company that is reasonably priced and in an uptrend, because stocks in an uptrend tend to attract more money flow. Stocks in a downtrend tend to have people selling them. It just is what it is. And if you can find reasonably priced stocks in an uptrend, then that's our sweet spot.
Got it. So going back to, you mentioned steel stocks.
Yep, Stelco would be a perfect example of that right now.
Stelco, okay.
Or Nucor in the US.
What's that?
Or Nucor in the US would be another example. Two stocks we do own that fit that bucket of being reasonably priced and in an uptrend.
And so I'm curious, I actually own Stelco. I bought it probably 2 years ago at maybe 15 bucks.
Yep.
Yeah, at some point it still was going to work. So, but I used to cover steel stocks very closely with the Goldman analyst, Aldo Mazzaferro. I don't know if you've ever come across him, but he was a great steel analyst. But anyway, but I am curious because obviously steel got hit yesterday. Everything got hit yesterday with the Evergrande China developer under pressure. It is causing some people to think that China might pull back a little bit on their developers and their growth. And that, of course, would impact, steel and aluminum going forward. What do you say to that?
Well, I think that is the risk for sure, is that property developers, that cycle in China is slowing, and Evergrande is obviously the 800-pound gorilla. But our general view is that we are in an inflationary period, and obviously the Fed has acknowledged it. But their view is that it's transitory. Our view is that it's transitory for longer. And that actually is a Goldman line, right? It's not ours, but we agree. We think that a lot of these issues that are causing inflation are not transitory. Labor is not necessarily transitory. Once you start raising wages to bring workers on, it's really difficult to go backwards the other way. That becomes a more permanent cost base and a permanent source of inflation. So, all inflation is transitory, but if it goes for longer, you've got the pressure of potentially higher rates, and we think you've got an extended cyclical cycle as part of that. We think the weakness in cyclicals that really started in April is much to do about two things: the Fed talking about tapering and the Delta variant. I think both of those are going to be resolved or are in the process of being resolved as we speak. We're going to hear from the Fed tomorrow. I think they are going to announce the timeline for a taper. The market's already ready for it. And taper does not equal tighten. And that's the key. They went to great pains to say that. The other thing is Delta has already started to roll over in the US where it's probably the most impactful. So I think this sort of growth scare, we might be looking past it for one more cyclical run. And that'll benefit steel stocks. It'll benefit copper. It may very well benefit lumber. Companies have an awful lot of cash, and they have been pretty stingy on the capital spend. So one of the ways if you're getting margin squeezed or your labor costs are going up, one of the things you can do as a company is spend on capital and get productivity gains. And we think there's a real chance that'll happen. So you don't necessarily get dragged into stagflation. It's a risk, but you can actually be growing alongside the inflationary pressures on your cost side.
So if you think that inflation will be transitory, but for a longer period of time, what do you think would be the short to that trade, in the sense that if most people or the media has been talking about, transitory is a couple months. If it goes on for, 2 to 3 years, there are going to be certain businesses, individuals, and sectors that get structured away that can't wait out the game in terms of a higher interest rate environment or higher costs. Have you looked at that side of the trade, and who would that be?
So, there was actually an excellent study that was published back in May, and it was really what works during inflationary times. It went back it was an academic study, went back to 1926 and looked at all the sectors and all the strategies in terms of what worked, what didn't. And it was pretty consistent, and it makes common sense. Anything that has pricing power or is a commodity producer or servicing commodity producers. So Canada fits well. There's a lot of industries that either directly or indirectly service commodity producers. They do well. And that's energy, that's materials, industrials to a degree if they've got the right, if it's a well completion company or something like that that's servicing that industry. What does really poorly are consumer staples and expensive growth stocks. And it's because you get overall multiple contraction. And so the companies that are most exposed to multiple contraction are the ones with the highest multiples already. So it really, the other side of that trade becomes these expensive growth stocks. We won't short Shopify just because it's expensive. It has to roll over as well, has to be in a downtrend. That really hasn't happened yet for a lot of these, but you can kind of see the writing might be on the wall of that trade, and inflation would be a catalyst to drive that. The other, small caps, you want to generally avoid smaller cap companies. They don't have the ability to control pricing on their supplies. So they do get squeezed more than the mega cap. And then interestingly, and this obviously is a shameless plug for our strategies, relative value strategies or long short momentum strategies do pretty well because they can get long things that do well during inflation and get short the things that don't. And that trend tends to be stickier. It doesn't disappear that quickly. And so that being a momentum investor actually makes sense. The other strategy, which we don't run, but does work really well, are CTAs, the old commodity trading advisors. That is kind of their perfect environment is an inflationary one. So that's kind of a mishmash of all the things that work.
I don't feel like I've seen any CTAs out for a while.
You sure haven't, because they have lost money for 5 years in a row. But that in some ways is the opportunity. If you can find the survivor that actually made it through the last 5 years of what has been a tough bear market for CTAs, they might have a place in your portfolio now.
Got it. And I don't want to take too much more of your time, but you did mention lumber stocks. Which ones do you like here? And obviously they had a huge run up, then they pulled back. Some great analysts were expecting them to pull back. Where are they now? I haven't looked for a while.
So the share prices have held in a lot better. They're, call it on average 15 to 20% off their highs, but those highs are obviously 300% off their COVID lows. So what's interesting is the lumber prices, the spot market ran up. We all know, like crazy. It became a popular theme on Twitter to talk about, I'm rich, I've got a pile of broken up lumber. Those prices have come back to earth. But I think what the spot lumber prices have, but I think what people should look at is spot lumber's trading today around $600. That is higher than any previous peak of any other cycle. So it looks like they've come off a long way, but at $600, a company like Canfor cash flows its entire market cap in 18 months. So you don't need, and these companies have all been paying down their debt. Frankly, you can buy most of them, whether it's West Fraser or Interfor or Canfor. They all look cheap. They all look like they're either paying down debt or buying back shares like crazy. If you just get a little bit of an extended cycle, you're going to see more of that. Special dividends, potentially M&A. And that's kind of been our view, is that that cycle's not over yet.
And they're still, even at these levels, because they're still, yes, they're off their highs, but they're way off their lows. Historically, this is an okay time to step into those names.
You have to believe that we're going to get that inflation for longer. But, and we do, and we think the market is set up for that. But even if they don't, you're buying companies with basically no debt in many cases, cash on the balance sheet, trading at 2 or 3 times EBITDA. I mean, they're exceedingly cheap. Now, they're trading on backwards-looking EBITDA that is blockbuster, but even forward, they're trading at 4 or 5 times EBITDA. If you just use the analyst consensus. And in general, I think the analyst consensus is probably a little more bearish than what spot price is telling you.
Got it. And just lastly, in terms of some of the shorts out there, Tesla is one. Are you short it now?
So Tesla's right. We are short it. If you look at its price chart, it's right at the cusp of starting to roll over on a momentum basis. It fought back in the last few months, so we'll see. We tend to be we're relatively fast. Let's call it an itchy trigger finger when it comes to our shorts. We won't let them run against us for too long before they get covered and we rotate to something else. So Tesla is still a short. We'll see if that sticks. But there's your perfect example of a thematic stock. No question, it hits all the right themes. They make very good cars, but it's an extremely expensive stock. And they now have a ton of competition coming to market in terms of new EV companies, both traditional automakers and new ones. So they don't have the run of the market anymore at very, very expensive valuations. I mean, they're worth more than every other car maker put together. And does that make sense for an automaker that sells less than 2% of global autos? It's pretty tough math.
Yeah. Just to wrap it up, you guys obviously have your approach. It sounds like, almost regardless of what's going on in the world, because your approach allows you to be nimble. But what would your kind of message to viewers who obviously don't have your background be as it relates to thinking about the market and maybe some of the volatility that we might see, even just given the seasonality?
Yeah, look, I mean, for the average client, I actually think the market they're best served by doing what Warren Buffett says: just go buy a cheap index fund, right? I mean, you don't need to pay high fees for regular market exposure. So find the cheapest, easiest to buy and tuck away exposure to index funds. That, and that applies to the bond market as well. And that should form the core of anyone's long-term portfolio, 50, 60+%. And then I think you look to either active managers or if it's a do-it-yourself investor, then I think you start allocating to things that don't look like the rest of the stock market. And that's, where alternative funds fit in. It's where alternative asset classes can fit in. But what you don't want to do is just pay high fees for a bunch of products that look exactly like what you just bought cheaply, right? So a lot of traditional long-only mutual funds, unfortunately, fall into that bucket. You might pay 2%, but all you're really getting is the same thing you bought at 50 basis points through your ETF. I actually think that too few people use advisors, right? I think actually having an advisor, their job is as much to keep you on course as it is to recommend investments, right? And having someone to hold investors' hands in a March of 2020 and not turn a temporary situation into a permanent one. In other words, selling when you absolutely shouldn't. I think there's actually a lot of value in an advisor, and they don't always, get the credit for that. But they charge a fee, but I actually do think they're worth that fee.
Yeah, that's well said. I mean, and they do sit in front of the screen every day, different capacity than what you're doing. In terms of your sophistication, but at least they're on top of it and watching everything for the client, because it is amazing how many people I know who, really, it's not their business, it's not their love. So they're really not up to date.
Right.
So yeah.
Right. If it's not, keep it really simple. Keep it simple and cheap. If it is your love, then you can start getting more complex and looking at, other strategies. But yeah, my advice for the average investor is just keep it simple.
Okay. Jason, we'll leave it there. Great to speak with you and get caught up in terms of what you guys are doing and how you're doing it.
Appreciate it. Yeah. Thanks for having me on.
Thank you.